The statement of earnings is the second out of three statements that constitute financial statements. The statement of earnings records the revenue and the expense for a given accounting cycle. That can be a month, a quarter, or a year. Whereas we say a statement of financial position or balance sheet is a position statement with amounts shown at a point in time. A statement of earnings, or profit and loss, or P&L for short, is a period statement. It records the revenues and expenses and resulting profit or loss for a period, a month, a quarter, or year. Balance sheet accounts are carried forward from one accounting period to another. The statement of earnings shows values for 1 month, quarter, or year. At the end of the accounting period, amounts are set to zero through what we call closing entries introduced later in the program. On a macro level, the statement of earnings shows the revenue for the period, the expenses, and the profit or loss for the period. Here in our example, revenue is the amounts billed to a customer for services rendered. Cost of services provided is the expense incurred directly to provide said services. Expenses are costs incurred to generate revenue. In our example, cost of services provided were $53,000 to generate revenue of $100,000. The $53,000 were direct costs. Gross margin is $47,000, $10,000 marketing expense of $12,000, depreciation expense of $12,000, total operating expense of $34,000. Operating income, or EBIT earnings before interest and taxes, of $13,000, gross margin $47,000 less operating expenses, $34,000 equals $13,000. Interest expense $4,000 and income taxes $3,500, net income $6,500. A word about earnings before interest, taxes, depreciation, and amortization. EBITDA. EBITDA is not a formal subtotal in financial accounting. The Financial Accounting Standards Board, or FASB in the USA, or the International Accounting Standards Committee, or IASC, internationally do not recognize it as a formal subtotal. However, in the investment arena, EBITDA is often cited as a measure of core profitability. It can be used to compare companies with different capital structures and capital requirements and tax environments. It is often cited in the quarterly earnings of a public company. In our slide, we see that EBITDA of $25,000 excludes depreciation of $12,000, interest expense of $4,000, and taxes of $3,500. The net profit is the same in both earnings statements. In this slide, we see what we call comparative income statements. Data shown this way allows us to compare the operating results of the current year and the previous year. Here what we see is that sales of the most recent year, 2023, are $100,000, a $10,000 increase over the previous year of $90,000. However, cost of services provided are $53,000 versus $43,000 of the previous year, meaning gross margin is the same for both years, $47,000. We see that operating expenses were in total $34,000 in 2023 and $31,000 in the previous year. As such, EBIT is $13,000 in 2023 and $16,000 in the previous year. Consider sales are up by $10,000 in the current year, yet operating income, or EBIT, is $3,000 lower in 2023 than 2022. In any business or economic entity, it is an ongoing challenge to increase sales but also reduce costs where possible. Here, interest costs were higher by $1,000 in 2023 than 2022, but taxes were $1,000 lower, so the net difference in net income was $6,500 versus $8,500 in the previous year, or $2,000 decline in earnings. Here we have sales of $200,000, an analysis of what we call the periodic method of inventory management. We start with beginning inventory of $40,000, purchases of $85,000. The two values above equals goods available for sale, $125,000, less ending inventory of $35,000. $125,000 less $35,000 equals cost of goods sold of $90,000. Sales of $200,000 less cost of sales equals $110,000. subtracting operating expenses of $83,000 equals operating income of $27,000. Subtracting interest of $4,500 and income taxes of $5,500, and we get bottom line income of $17,000. In this statement of earnings in 2023, we have a company that sells products. To calculate the cost of the merchandise sold, we start with the beginning inventory, which is $40,000. We add the purchases of new inventory of $85,000. Adding the two together, we get goods available for sale of $125,000. We have ending inventory of $35,000, which we subtract from goods available for sale of $125,000, and we get cost of goods sold of $90,000. Subtracting $90,000 from sales of $200,000, and we get gross margin of $110,000. For 2023, operating expenses are $83,000, resulting in operating income, or EBIT of $27,000 and net profit of $17,000. In the statement for 2022, we get a cost of sales of $83,000, gross margin of $107,000, operating expenses of $79,000, operating income, or EBIT, of $28,000 and net profit of $18,200.